Next, let us consider off-balance sheet financing. Off-balance sheet, OBS. Off-balance sheet may be an off-balance sheet asset, may be an off-balance sheet debt, or may be off-balance sheet financing. Off-balance sheet, what do you mean by off-balance sheet? Outside the balance sheet. So I take a financing, I take a loan, but it is not reflected in the balance sheet. That is what off-balance sheet financing would refer to. Let us take a look at this. What is off-balance sheet financing? It is a form of financing. As the name suggests, it's a form of financing. So it's an arrangement which is made. Usually it involves huge capital expenditures. That is why I do off-balance sheet financing. It's not a simple transaction. Normally this is slightly complex transactions. But because the amount involved is large, because I want my balance sheet to look good, what do? I go for an off-balance sheet financing, which is nothing but an arrangement which is kept out of the company's balance sheet. So I have an economic obligation. They create economic obligations, but arrangement is made in such a manner that it can be kept out of the company's balance sheet. So somebody else who looks at the balance sheet sees that this company does not have too much debt, keeps the debt equity ratio low since there is no additional liability on the balance sheet. So the balance sheet looks good because this financing is kept out of the particular balance sheet. Mind you, we are not talking of illegal transactions here. This is a form of financing which this is a kind of arrangement which is accepted and which can be done. Of course, it can be misused. Let us get to that slowly. Let us look at why it is done. Why would you opt for balance sheet financing? Because naturally it gives you a cleaner balance sheet, a better balance sheet, a more good looking balance sheet, something which looks more attractive to the creditors. When creditors, people who have to lend money to the particular company, look at the balance sheet, they say, oh, there's hardly any debt, so it's fine, it's in a good position, I can lend money to it, not a problem. The company will be in a position to repay my debt and interest. However, if I look at the balance sheet of a company which has a lot of debt, then I am scared. I know that this company already has debt. It already has to make repayments, right? What happens if you take debt? You have to make repayments periodically, yes or no? Usually periodically, not necessarily, because you could also make repayment at the end of the loan term, and I have to make interest payments regularly. Yes or no? Interest payments regularly. These are all outflows. Any creditor. So for example, if somebody asks me to invest in a company, put money in a company, or lend money to a company, one of the first things I look at in the balance sheet is how much of debt they already have. If they have too much debt, it is called over leverage. You'll understand these concepts as we discuss the other sections of your part 1. But just understand simply, basically what is happening. I'm looking at the balance sheet of that company and I see they already have a lot of debt. Why are they taking more money from me? I don't feel safe. I know it could be risky. So I would not lend money to them. But if that company has made an arrangement in such a way, in a manner they are actually taking financing, but they have managed to keep it off the balance sheet, it is not shown. When I look at the balance sheet, I might think that this company is fine, it doesn't have too much financing. Maybe I can lend money to the company. Of course, mind you, these off-balance sheet financing have to be disclosed in the footnotes. So if I am smart enough, I would go ahead, look at the footnotes and ensure that there is no off-balance sheet financing, or what is the amount of off-balance sheet financing, and then take an informed decision on whether to lend money to the company or not. So why do we go in for off-balance sheet financing, or why do companies go in for off-balance sheet financing? Mostly because it gives you a more good-looking balance sheet, a better balance sheet, and a balance sheet which is more appealing to creditors, future investors. Next, it reduces taxes. Usually what happens is when we take financing like this, like I said, there should be repayments. When money is repaid, there have to be repays, right? So there is some financial obligation somewhere, it's not appearing in the balance sheet. When the repayments are made, these repayments are shown as expenses. They are shown as expenses. So what happens? If they are shown as expenses, more expenses, therefore less profits. If you have less profits, what do you have? Taxes are reduced. Yes or no? So these are the two important reasons why off balance sheet financing is resorted to. It may offer greater liquidity. For example, instead of purchasing an asset outright, what I do is, if I purchase an asset outright, what happens? Money is blocked up in that asset, right? Now, instead of that, I keep it off the balance sheet so that money which I would have been blocked up in the asset is released. I don't buy the asset. Instead, I tell the person, let me pay you in installments. I want to use your asset. Do you get it? I'm not buying the asset, but I have the privilege of using the asset. I have the right of using the asset. Why do I get the right? Because I pay the owner of the asset money. This money that I pay to the owner of the asset over a period of time adds up to the cost of the asset. So though I have actually purchased an asset, it has not come into my books, and I am not blocking all my money in the purchase of the asset. I'm just having some expenses every year, and therefore I have more liquidity, greater funds available at my disposal. Let us look at the types of balance sheet financing. Operating lease. What is operating lease? In simple languages, it is rental, students. Now, suppose there is a huge vehicle, and for simplicity's sake, let us take the vehicle costs around 100,000. Okay. Now, I don't have the money to buy this vehicle for 100,000. Maybe it's something I have to use regularly in for transporting goods, whatever, right? But I don't have the money to buy this. We as a company don't have the money to buy this immediately at 100,000. I repeat, the figures are for simplicity's sake, just for understanding. Now this is 100,000. Now I speak to the owner and I say, see, I cannot buy this. I will do one thing. I would like to rent your vehicle and I will pay you 25,000 per year for 5 years. So what am I paying totally? 125,000, but over a period of 5 years. So can I say this is nothing but like buying an asset and paying the person in installments. I am buying the asset, paying the person in installments, and the interest element is involved because ultimately I end up paying 125,000. Followed. This is a case, and maybe that vehicle would anyway last me only for 5 years when I would have charged depreciation. So the owner of the asset continues to show the vehicle in his books, but I use the asset in my books and I show this 25,000 as an expense. What expense? Rental expense, hiring charges, lease charges, rental charges. Yes or no? So this is a kind of off-balance sheet financing, because in effect, instead I should have actually been showing vehicle as an asset in my books. This is an asset. Yeah, and I don't have the money. Where does the money come from? Money would come as debt. This is totally avoided. There is instead an arrangement of financing without the financing or the loan appearing on the books. So what has happened? No loan in the books, but there is expense in the books. So debt equity ratio looks better, and because of the greater expenses, profits are reduced and therefore taxes are also reduced. Followed, students? This is the simplest, the easiest to understand example of an off-balance sheet financing. Factoring with recourse. Factoring, do you remember what factoring is? Factoring, when we discussed debtors, we discussed the term factoring. This is another interesting thing. I have a lot of trade receivables, maybe 500,000 debtors in my books, right? This is my asset. Now, it will take time for this money to come in. Somebody may pay in 2 months, 3 months, 6 months, and so on and so forth. But maybe I need cash. So what do? I resort to the function of factoring. What does factoring do? They buy. What does a factor do? A factor will buy the debtors from me. So they'll take this debtors. They'll say, you sell us the debtors, we will give you 500,000 against the debtors. Of course, if you remember, they don't give exactly 500,000. They may give a little less after reducing their commission charges, their interest charges, and keeping a small percentage as reserve. So even if they give me 450,000, let us say, they are giving me 450,000, 480,000, whatever figure. I'm just taking it for example. So what happens? This is money I get immediately. Have they collected this money? No. Have they collected this money? No. But I get this money immediately. So can I say they are actually lending me this money, but nowhere in my books will this appear as a liability. Nowhere in my books will this appear as a liability. This is therefore a kind of off-balance sheet financing. Why do I say with recourse? Because if a debtor defaults, if this money cannot be collected, then I have an obligation that the money that I have received here, I will have to return to the factor. So factoring with recourse is actually an example of off-balance sheet financing. Why? Because they are giving you money before they have received. This is actually in the form of a financing, but the financing of a loan does not appear in my books. I just sell debtors, debtors go off my books, cash comes into my books. Colored. Research and development partnership. This is quite common actually. What happens is for companies which have to invest a lot of money in research, the money which is invested in research and development can be quite high. Sometimes we need to take financing for the same. What is done is the main company opens another company or another partnership firm, and all expenses, liabilities, etc. are actually recorded in the books of this partnership or this new company. These are not reflected in the main company's accounts. So everything is reflected in this other partnership firm. Joint venture. So also is the idea of a joint venture where 2 or 3 companies may come together and start a project. So this project itself would be a separate entity, and all investments are made into this entity. So this entity may have its assets and liabilities all separately. Nothing is reflected in the books of the main companies who have entered into the joint venture. So they have a clean balance sheet, but everything else is reflected in this venture's balance sheet. So also is the case with unconsolidated subsidiaries. We did a holding company and subsidiary when we were discussing assets. So what happens is there is control of a subsidiary. Some activities, some liabilities, etc. are taken by another company, the subsidiary company, a small company, right? Now, because we don't have total interest, there is a controlling interest. Suppose you have more than 51% or more of the stake in this company, then the assets and liabilities of this company are supposed to be shown along with the holding company or the parent company. Yes or no? But suppose I don't have that kind of ownership, then the assets and liabilities here are not consolidated. That is why rules are sometimes changed, the law is sometimes changed, and now you have something called the definition of a control, and they say that it is not necessarily only the ownership which will define control, it can be also actual or effective control. Nevertheless, it is quite possible that a company starts another company and then sells off all its controlling stake to other investors, so that this is not reflected. Any part of this is not really reflected in the company. These are all certain examples of off-balance sheet financing. I have already discussed them. Let's just go through them briefly. Operating lease is a kind of off-balance sheet financing, particularly when the whole cost of the asset is actually covered. That large cost of the asset is covered over the use of the life of the asset through the payment of rentals or hire charges. So what happens here? Operating lease, you have the owner who is going to rent it out. He is called the lessor, right? The owner gives it to the tenant. This is not using a vehicle. We call this a lessee. We don't really say a tenant. Tenant is used more for premises. So what you understand as a tenant is the lessee, who will use the asset and will pay the rental charges. So who uses the assets? Lessee uses the asset. Who is the owner of the asset? Lessor is the owner of the asset. Is there an asset in the lessee's books? No. Only you have annual rentals as expenses. When you have annual rental as expenses, what happens? Profit comes down. Do you remember? Profit will come down. Therefore, taxes also come down. So this is a benefit I get. In the lessee's books, I don't have asset, I don't have liability. Though, remember in my example what I said? He was actually giving 25,000 per annum, so that he actually paid 125,000. Cost of the vehicle was only 100. This is cost. This is the total payment made by the lessee. Yes or no? It covers the cost of the asset. The vehicle would probably have been used for only 5 years. It would have depreciated over the payment of 5 years. But instead of showing that he has taken a loan of 100,000 with an interest of 25,000, this is simply shown as an expense in the company's books, in the lessee's books, right? Lessee may finally purchase the asset for a nominal amount. At the end of 5 years, if the vehicle can still be used, the lessee may purchase it, but the lessee would purchase it at a much depreciated cost, and therefore the value would be really low. Off-balance sheet financing, factoring. Factoring, do you remember? Sale of receivables. So the receivables are sold. I get money, though it is not collected from the debtors. So in fact, the factor is lending money. Yes or no? Factor is actually lending money. Factor is actually lending money. Factor is actually lending money. Now, usually this is factoring with recourse. With recourse means the factor can get back and collect the money from us if the debtor does not pay. So anytime there could be a liability if the debtor defaults. These things work fine as long as there is no default, etc. But the moment there is a default, then the parent company stands to lose. They may not have realized, because it's never there on the balance sheet. Over a period of time, it could build up. So this loan from the factor does not appear in the balance sheet. So factoring with recourse is also a form of off-balance sheet finance. I hope you've realized why. Money is being given by the factor, though the money has actually not been collected by the factor. Is it shown as a loan? No, it is not shown as a loan. The debtors just go out of the balance sheet and instead cash comes into the balance sheet as if I have collected money. The liquidity looks good. The debt equity ratio looks good. Good balance sheet. R&D partnership. Research and development can be really expensive and there would be no corresponding asset against the funding received. What happens is for research and development, a lot of money is involved, and sometimes we need money, we need funding to carry on the research and development. So this funding would appear as a liability. That is why a separate entity is created which does only the R&D. So the parent company, the loans taken by this partnership are not reflected in the main company. There is no asset or liability in the company's books. This is very common in the pharma industry, where research on a new drug, etc., can take a very long time. The same concept with joint ventures and subsidiaries, where a separate entity is actually created and selected assets and liabilities can be transferred to the entity, to that entity, and they do not reflect on the main company's balance sheet. Off-balance sheet financing is discretionary. Is it legal? The question here is it legal? Mind you, when we discuss this off-balance sheet financing, we are not discussing anything illegal. What is being done is standards and the rules and laws are being followed, but it's a kind of smart accounting techniques which are being adopted. It's not against laws, not against things. And what they have done is the law, the standards, in order that common investor is not duped. Now they have said what you require to do is that there should be adequate disclosure in the footnotes. Each time the off-balance sheet financing is used, or not off-balance sheet financing, smart accounting techniques are used making use, let me say, of the loopholes in the law, in the standards, then the standards get more stringent, and these loopholes are slowly taken care of. So it is a matter of evolution. But please understand, off-balance sheet financing is not against the law or illegal. It can be used. It can be used for fraudulent practices. That is actually a misuse. But per se, this is not illegal. This is not against the law, not against the standards. Please be clear. It is a smart way of accounting when all the provisions of the law or standards are adhered to. I repeat, there should be adequate disclosure in the footnotes for those of you who are looking at the balance sheets of companies. So do look at off-balance sheet items. There have to be notes. So do go to the footnotes and take a look at whether there are off-balance sheet items. To conclude, let us take the shortest possible quiz on off-balance sheet financing. Which of the following statements is true? With off-balance sheet financing, the debt-equity ratio goes up. B. An arrangement of operating lease has the effect of reducing taxes. C. Off-balance sheet financing is an illegal practice. D. Issuing a bond for a discounted price is a kind of off-balance sheet financing. Read all of these sentences. Is any of the statements true? Are all of the statements true? Are all of the statements false? Are two or more statements true? Take a look, students. Understand, think, and answer. This will help you to more or less understand the concept behind off-balance sheet financing. Okay, let's take them one by one. With off-balance sheet financing, the debt-equity ratio goes up. No, what happens with off-balance sheet financing? It's a financing does not appear in the balance sheet. Yes or no? Does not appear in balance sheet. Therefore, does not appear in balance sheet. So there is no debt and debt-equity ratio does not go up. No debt. Yes or no? Therefore, debt-equity ratio. Therefore, this is wrong. Right? Debt-equity ratio cannot go up. An arrangement of operating lease has the effect of reducing taxes. Does it? How? An arrangement of operating lease. What happens in operating lease? You pay rentals. What is rental? Rental is an expense. More expense, therefore less profit. Therefore less taxes. Therefore less taxes. Yes or no? Therefore this statement is definitely right. Let us look at the other ones. Off balance sheet is an illegal practice. No, mind you students, it is not an illegal practice. It is legal. It is in accordance with the law. It is in accordance with the law. Issuing a bond for a discounted price is a kind of off balance sheet financing. Is it? No. What happens when you issue a bond for a discounted price? The price is adjusted depending on the market rate of interest. Yes or no? If the market rate of interest, if the market interest rate, right, is higher than yours, you will have to give it at a discount. Only then people will invest. It is not a kind of off-balance sheet financing. The amount of money received and the maturity value are both reflected in the balance sheet. So it is not a form of finance. So the correct answer is B. Which of the following statement? Only B is true. Clear, students?